For 10 years, the South Korean market remained one of the worst performing options for global investors. However, in recent years, the narrative has shifted. The KOSPI is currently outperforming the US indices, the Nikkei, and the DAX. What's driving this KOSPI outperformance? A look at Apple and Samsung provides a clear illustration. While they appear to be peers in the global smartphone market, a massive valuation gap exists. Although Apple's revenue is approximately twice that of Samsung's, their profit margins remain comparable. Despite this, Apple's stock has tripled Samsung's growth over the last decade. Plus, Samsung's price-to-book ratio is often shockingly low, sometimes even dipping below 1. This means that if you theoretically bought enough shares to own the company today and immediately sold off its physical assets, the factories, the land, and the machines, you would actually turn a profit instantly. Even when comparing Samsung to a direct peer like TSMC, the disparity is striking. Both companies are anchored in Asia and navigate similar regional market dynamics. Yet, the valuation gap persists. Whether analyzed as a consumer electronics or a semiconductor company, Samsung consistently trades at an irrational discount. This isn't unique to Samsung. It's a systemic issue known as the Korea discount, a phenomenon where companies see their valuations slashed simply for being listed in the Korean market. However, we are witnessing a historic shift. Why is the Korea discount finally evaporating? And what is driving the market toward a valuation premium today? The first factor driving this boom is the semiconductor supercycle. Right now, only 3 companies dominate the high-bandwidth memory market: Micron, SK Hynix, and Samsung. In South Korea, Samsung and SK Hynix together command nearly 40% of the KOSPI's total weight. Essentially, as their stock prices climb, they pull the entire market up with them. Second, we have the Korean Value Up program. This is the government's direct action on the chronic Korea discount. They started by tackling the dividend drought. Historically, South Korea had some of the lowest payouts in the developed world. To fix this, the government introduced a double-sided tax incentive: lower corporate taxes for companies that boost dividends, and lower income taxes for the investors who receive them. The goal is simple: make it cheaper for companies to share the wealth and more profitable for you to hold their stock. But if you want to know the real game changer, you have to look at the director's fiduciary duty. For decades, Korean law stated that directors only had a duty to the company, a loophole often used to favor founding families over regular investors. That changed with the landmark 2025 amendment to the Commercial Act. Now, directors have an explicit legal duty to all shareholders. This means they can finally be held accountable if they approve a deal that helps the founding family while hurting minority investors. The LG Chem splitoff is the textbook example of how Korean corporations exploited legal loopholes for years. Investors poured capital into LG Chem, not for its legacy chemical business, but for its EV battery division. By early 2021, anticipation drove the stock price above 700,000 won per share. However, management then executed a vertical splitoff, isolating the battery business into a separate entity, LG Energy Solution. Initially, LG Chem owned 100% of LG Energy Solution, but the real betrayal happened when LG Energy Solution held its own IPO. For investors who backed LG Chem specifically for that battery growth, the company was suddenly a hollowed-out shell. As the market realized they no longer held direct ownership of the growth engine, LG Chem stock plummeted nearly 15% from its peak. For a long time in Korea, shareholders had no choice and zero compensation. They just had to watch their value evaporate. Why did boards do this? Because under the old laws, their fiduciary duty was to the company as a legal entity, not to you, the shareholder. If a move helped the company raise cash but wiped out retail investors, the law said the board was just doing its job. By splitting off LGES, LG Chem raised $11 billion in fresh capital. From their perspective, It didn't dilute the founding family's control, and it didn't come with the high interest of a bank loan. It was, quite literally, the cheapest money they could find. But they raised that capital by selling your growth potential to a new group of investors. It's exactly this kind of behavior that forced the 2026 Value Up program to finally rewrite the laws on director duties. With these legal reforms finally in place, investors aren't just hoping for higher prices. They're betting on a fundamental re-rating of the entire Korean market. But the question remains, is this a permanent structural shift, or just a lucky outlier in the history books? Between escalating geopolitical tensions in the Middle East and an index that's still heavily dependent on the semiconductor cycle, the path forward is anything but a straight line.